Hi guys, we're back. So now let's talk about adjustments to the standard unqualified/unmodified financial statement audit report. Now remember, these are not going to be things like the qualified opinion or the adverse opinion just yet. These are actually reports that are still considered to be unqualified, but we just have something we want to emphasize. Okay, so these are 5 main situations that would require you to add explanatory language, or what's also called an explanatory paragraph. So one is when we reference a separate report on the audit of internal controls. So we talked about this idea that public companies have to have an audit of internal control. Sometimes they'll just have one big opinion for both the financial statements and internal control, but generally they'll have 2 separate opinions. So I have my opinion here on the financial statements, then below that I'll show my opinion on internal control. And so what they do in these cases is in their main opinion on the audited financial statements, they will add a reference to this. They'll say, hey, we also audited internal controls over financial reporting. That was an unqualified opinion. And then you'll see the second opinion later. So there is reference to it. It is considered kind of explanatory language. Number 2 is when another auditor is involved in the audit. And we have a separate slide, so I'm going to go to that for now. This can happen when parts of the audit are audited by another firm, and it can be an affiliate. So let's say I'm auditing a US-based company and they have a major subsidiary in the UK. So we may have our affiliates, the EY UK people, do that portion of the audit for us and then send us their findings. Now, in theory, a whole separate audit firm could be doing that. So let's say I'm EY US and it could be like KPMG UK is auditing the UK subsidiary. So it could be just an affiliate with the same firm, or it could be an entirely separate audit firm. So when this happens, auditors actually have a choice on what to do, on whether or not they want to refer to this other auditor in their report. And often what you'll see is there's no mention at all that there is another auditor. What that means in terms of legal liability, though, is the main auditor has to take legal responsibility for 100% of the work. Right? And generally, if you just have an affiliate, like you have EY US and EY UK, you won't separately reference their work. You'll just say, hey, we EY are issuing this opinion. So then we also have the situation where we want to reference this other auditor in the opinion. And of course, the benefit to doing this is you won't have to take responsibility for that other auditor's work. And this is what we tend to see if it's an entirely separate audit firm doing the work. So the EY US versus KPMG UK. So we're definitely going to want to reference KPMG UK because we don't want to take responsibility for their work. And in this case, we see extra explanatory language being added to the opinion and basis for opinion paragraphs. And we have an example here. So you'll see in both the opinion section, we're referencing, hey, part of our opinion is based on a report from other auditors, and we didn't audit this particular portion of the company. Those statements were audited by these other auditors. They gave us the report. And in the basis for opinion, you'll also see reference to it, right? Like the basis for opinion is all the evidence we gathered, plus the report of these other auditors that we're relying upon. So let's go back to our first slide. And we see the third reason why we would make modifications to our report is if there's substantial doubt about an entity's ability to continue as a going concern. So here we have our slide that goes into more detail about this. So the basic assumption when we're issuing an audit opinion is that that company is going to stay in business, right? And typically, as auditors, we are expected to be able to forecast just for the next year. So in a typical audit opinion, if we don't mention anything about going concerns, It means we expect this company to stay in business for at least the next year, right? There's no danger that this company is going bankrupt. However, if we get in a situation where we think it's possible or likely that a company is going to go bankrupt within the next year, right? 1 year beyond the date of the financial statements, then we need to think about adding this going concern language to our audit opinion, which basically says we have substantial doubt about the company's ability to continue as a going concern or stay in business. Now, I want to give you a little bit of clarification on this language, because being a going concern is actually a good thing. It means you're staying in business. So this whole continuing as a going concern means like a company is going to stay in business. So going concern is good, but a going concern opinion is bad, because what it means is if we're bringing up the words going concern at all, really we're bringing up the words, so this is my example opinion, it's always in this phrase. It's substantial doubt about this company's ability to continue as a going concern. So if you get a going concern opinion, that's bad. It means the auditor thinks there's a pretty good chance this company is going bankrupt within the next year. So we want to be continuing as a going concern. And if we get a going concern audit opinion, that means they think we're not. There's substantial doubt about our ability to continue. Okay, and next up, we have number 4 on our list of why we'd add some explanatory language, which is a lack of comparability due to inconsistent accounting principles and other things. Okay, so let's go to this slide on lack of consistency. All right, so sometimes we have changes that impact both comparability and consistency. And basically what that means is your financial statements for this year versus your financial statements for last year are not directly comparable. I'm not comparing apples to apples, I'm comparing apples to oranges. And when that happens, the auditor likes to point that out so that it's very obvious to users of financial statements that they're not comparing apples to apples, right? And so things that could cause this would be things like a change in accounting principle. So if a company shifts from straight line depreciation to accelerated depreciation from one year to the next, basically when we compare those two depreciation numbers, we want to know that we're not comparing apples to apples, right? So we point it out as auditors, and we'll have an extra paragraph that talks about this idea that these financial statements, that there's some aspect of these financial statements that we can't compare exactly. It could also be a change in reporting entity, right? If one year you're unconsolidated, the next year you're presenting consolidated financial statements, obviously I'm not able to compare those two directly. Or it could be because there's a correction of a misstatement in prior year's financial statements. So this would happen if later on after, right, initially we issued an unqualified opinion, we thought everything was fine, but later on we found out, hey, these financial statements need to be restated. There is some big error in them that we didn't catch, right? So the auditors failed, and then we need to acknowledge that, hey, we've gone back to correct these prior year financial statement. These are things thought to impact both comparability and consistency. Sometimes we have a change that involves lack of comparability, but there's no lack of consistency in application of principles. And in that case, you do not have to call it out in the audit opinion. You don't have to add explanatory language. So examples of this would be, right, so remember how an example of lack of comparability and lack of consistency was a change in accounting principle. We changed our guiding principle for how we account for depreciation from straight line to accelerated. So now let's say we're using straight line in both years, but we changed the useful life of a depreciable asset. Okay, so this is something where we can see the underlying principle guiding how we do depreciation hasn't changed, but we're adjusting our useful life. You can also have a change in classification or reclassification. So an example of this would be if you have a building and you decide this year it's no longer in use, it's going to move from the PPE section of the balance sheet to the investment section of the balance sheet. So again, it's not that you are changing some principle, it's more that the way you're accounting for that particular asset has changed. And if you have a change in accounting principle, but the impact is immaterial, you don't have to mention it. It could even be like you're going from straight line to accelerated depreciation, but there's no material impact on the financial statements, right? So let's say I'm Apple, I make this change and it's only like a 50K difference, right? We know because Apple's financial statements are so enormous, a 50K difference is not gonna matter, right? It's immaterial to everybody. And so if we have a change like that, we don't bother to call it out in the opinion, simply because you're still basically comparing apples to apples just because the dollar value is not significantly impacted. So I would take care to study these. If I give you various examples or various situations, you want to know if those situations would represent just lack of comparability, but the same accounting principles, or if the actual accounting principle is changing or the reporting entity is changing and we need to actually call these things out in the opinion.